The COVID-19 health crisis has literally brought the entire world to a grinding halt, severely impacting the global economy. At times like these, it becomes more important for businesses to diversify and implement alternate strategies to ensure the inflow of working capital and continuity of capital flow in the economy. To shed more light on the subject, we have with us a very special guest, Sir Martin Sorrell, Executive Chairman, S4 Capital, founder WPP, to share his perspective.
When I left WPP, and I chose to focus on growth, because that's what drives certainly the markets, not just the listed markets, but the private equity markets and the private markets and the family controlled market piece, which last year was around 245 billion to 50 billion, will be roughly the same this year. So despite the fact that the overall market has fallen by about, let's say, 15%, traditional media has fallen by almost double that, and digital has remain constant. And as a result of that, digital's market share is now over 50%. Even the Financial Times has woken up to that just recently. And next year, we think it will be, or the year after, it will be 57.5% by 2022. And by 2024, Michael Nathanson, one of the best analysts, media analysts in America, forecasts it will be 2/3 of the media market. And of course, there's other parts of the market as well that we're interested in, about 500 billion in public relations and market research and data, and another 700 billion in trade budgets. So the whole addressable market for S4 is about 1.7 trillion. The second point was that there were three areas. I mean, WPP is run into hard times. It's been a tough environment for the last few years, but particularly for them and the ad holding companies for the last two years. But if you looked at the portfolio that I left behind in 2018, the $20 billion portfolio, there were three real areas of growth. First party data, digital advertising content, and data and analytics and programmatic. So we started to build S4 around those three pillars. And today, of course, we've developed a very strong content pillar and a very strong data and analytics and programmatic pillar. So this is a new model. It's an iterative model. It's a 24/7 model, always on. It's rather like an election model. It's in terms of style, but without an election date, because we think brands and clients have messages coming at them. Orcs model is what I call it. When we do a piece of work for Netflix, we can create about 1.5 million different creative executions, and depending on the consumer response, we'll tailor it. So that's the second principle. The third principle is faster, better, cheaper. Faster means agility. That's the key corporate attribute, whether you're a tech company or whether you're an analog company. And so agility is key. Better means understanding a large number of companies even more closely. So the 6 platforms, Google, Facebook, Amazon, Tencent, Alibaba, and TikTok, which is the one that's broken through. Those platforms dominate digital advertising. Last year, Google was 165 billion. Facebook was about 65 billion of ad revenues. Amazon was about 15 to 20 billion, and TikTok had broken through to about 7 billion. And of course, I should probably add Reliance. I mean, we've seen yesterday the launch of Google's investment in Reliance Jio. And I think, although Reliance is an Indian company at the moment, there are signals and signs that with 5G, it will become a force, not just Jio and Reliance, not just in India, but beyond. So the platforms, then of course Apple and Microsoft, and of course Adobe, Oracle and Salesforce, and IBM and SAP, and Twitter and Pinterest and Snap, and then of course Samsung and LG, Netflix and Disney Plus. These are the companies, these are the software platforms, these are the hardware companies and the software companies and the platforms that we have to know fully about. So that's better. And cheaper means efficiency. not ZBB, not zero-based budgeting, because I think that tended to ignore the investment needed in innovation and branding, but really being efficient, particularly in a low growth world where there's very little inflation, and therefore little parallel, in my experience. I think the only parallel you could go back to would be a world war, because it has affected everybody. Hasn't affected everybody equally. It's a common misconception. It's affected the underprivileged and the poor and the underrepresented and the under-resourced more than the rich and the privileged. And that applies to nations as well as individuals. I mean, one of the things that worries me is not just inequality within countries, but between countries. And how does COVID-19 affect, say, India's position on the world stage? There are plus points, for example, in terms of global supply chain, but the impact on India and the population in India of COVID-19 is potentially and is extremely worrying, not just from a health point of view, but from an economic point of view as well. So clearly, when one thinks about COVID-19, you have to think about it in those terms. But as far as the shape of it is concerned, I rather like the argument that this is like a reverse square root. So if you think about it sort of globally, you've seen so reverse square root to me seems to be a better description than necessarily V or U or W or L. And I'll come on to that in a second, because I think you have to think about it, the shape and the impact in terms of different verticals and different categories. But that's general overall. The swoosh, as an example or as a parallel, I think is not the right one, because it implies that you're going to go above where you were before, whereas in fact it may be difficult, certainly for the economy generally, in the short to medium term, to get back to where it was in 2019. Now, turning to sectors, there are clearly sectors of the economy that are going to be less affected and more affected. The tech sectors, for example, the companies that I mentioned, the recovery is going to be more V-shaped. Out of those tech companies, those 20 or so tech companies, including Reliance or Geo, beyond those tech companies, if you take packaged goods, there are going to be packaged goods companies like Procter, which had a record first calendar quarter, not its first financial quarter, but first calendar quarter, and we'll see how it did in the second calendar quarter of the year. But because of their product portfolio, because they had jettisoned their food business under A.G. Lafley some time ago, and because Mark Pritchard, the CMO, has really, I think, sort of embedded the Netflix model inside Procter, 1.2 billion consumer profiles, 1.3 billion, so equivalent to the population of India, and looking at that data and creating content either in-house or embedded with agencies inside Procter or outsourced them, created content and pumped it out programmatically or algorithmically to see what the responses are. Sort of very similar model. Procter has had a better time of this recession. And interestingly, they've continued to invest in their marketing. Other packaged goods companies, Unilever has had a good time too, but of course it has a food business, which has been affected. Its food service division, its ice cream division has been affected by lack of distribution because of COVID, but generally good. And companies like Colgate, with a much more discrete focus, or L'Oreal, or Nestle, with a wide portfolio, but again, benefiting because of the nature of their products, have been quite strong. So packaged goods varying, I would say more U-shaped in terms of response. Some are flatter U, some are narrower U, when their product portfolio, like a Procter, is more attuned, or a Reckitt Benckiser is more attuned to what's happening with COVID in terms of detergents and cleaning products and personal care and the like. Then there will be more L-shaped categories. I think autos fit more into a more flatter U. Autos don't just have the issue of dealing with COVID-19 and the recession. They also have the issues of dealing with technology, dealing with the changes that a Tesla is bringing in terms of electric cars or autonomous driving. But I think flatter U in the case of autos, but still U-shaped. And then obviously healthcare has done well. I think that you put that more into the V-shaped category. Healthcare and tech have been the big drivers of the US stock market, for example, or indeed world markets. And by the way, this has not been a phenomenon that has been confined to C-19 and the COVID era. Healthcare and technology have been driving the US stock market for about 4, 5, or 6 years. You take out the growth in the FANGs or the healthcare companies, and you have very little growth in the indices beyond those two verticals. So another V-shaped sector would be healthcare, which, you know, sadly, C-19 plays to the strength of healthcare and life sciences businesses. More L-shaped areas would be obviously areas like travel and hospitality. I personally think it will be very difficult. You know, in our own case, we've reduced our travel budgets to zero. I've heard other companies, for example, in the restaurant industry, saying they've reduced their travel budgets to zero and they will not go back to more than 50% of where they were before. So I'll come on to that in a second. But clearly, there is a change in habits. So broadly, I would say reverse square root, if you're looking for a way of thinking about general recession, the general impact of the recession, recovery, a sharp recovery, but maybe not to the levels overall that we were before for some time. Swoosh is not the right analogy, implying it goes beyond where we were last time. But then within the general economy, there will be V-shapes, there will be U-shapes, there will be Ls. And of course, there is the phenomenon of the W. As we get reinfections, there will be slowdowns. But basically, I think the eye of the storm, famous last words, has passed. Obviously, in Latin America, we still have some issues, particularly in Brazil, Argentina, Mexico City. We have issues, obviously, in India, around Mumbai and Delhi and elsewhere. And there are resurgent issues in Hong Kong, in Tokyo, and other parts of Asia as well. Singapore, we've seen some lockdowns, although they're coming out of the lockdowns now. So there will be some fluctuation until we get vaccinated, until a vaccine is implemented, which looks as though it may be the middle of next year. So around about this time next year, we may have a vaccine distributed which will deal with it. But there may be other strains of the virus that, or indeed other pandemics at some point in time we have to deal with. So that's the sort of shape. And I think it's important to understand that Q2, in the case of S4, April was the trough. We bottomed in terms of top line growth, gross margin or gross profit around 3% in April. As we said yesterday in our fundraising, that May was better at around 5%, just under 5%. We think June will be better. So I think Q2 is the trough. And when you look at the Q2 results that are coming out, we've just seen the banks come out with their results like JP Morgan and Goldman and Citibank, etc. Heavy provisions, but maybe over provisioning because anticipating the losses because of the uncertainty around future bankruptcies. But essentially Q2 is a bit of a bloodbath, if I can put it that way. But I think Q3 will see a relative recovery, Q4 a relative recovery, and then 2021, I think we will see that reverse square root recovery come into view. And I think certainly in the digital world that it will be improved, which brings me to my sort of third point. We've talked about S4, we've talked about the shape of the impact. And I think the impact is basically one of acceleration. The impact of COVID-19 is to accelerate digital transformation to a degree that we haven't seen before. Satya Nadella at Microsoft was the first one to coin the phrase, I think, where he said, you know, we've seen, 3 years transformation within 3 months or whatever the analogy was. And others have used very, very similar analogies. And there has been a general acceleration at 3 levels. At the consumer level, consumers are buying online. 1/3 of US households are buying online for the first time. They're buying groceries and essentials. We're communicating online as we are here. We've seen at S4, massive conversion of live events to online events. We're doing it in sport. We're doing it in fashion. We're doing it in a number of areas. People forget that tech companies sell their products and their licenses through live conferences, or have done before, or healthcare companies sell their products by reaching doctors and hospitals with physical sales forces. You can't do that anymore, or certainly for a distinctive period of time. So you have to find alternative ways, real-time ways of doing it. So we're communicating online, we're shopping online, we're doing our financial services online, cash-free societies, payments online, we're educating our kids online, not as effectively perhaps as we would wish, but the technology will improve. And you see it with a Geo. I think Mukesh Ambani has been extraordinary in his vision for Geo, and he's attracted investments from Facebook and Google, along with companies like KKR and others. Quite extraordinary to be able to do that, and building a platform with 5G potential, not just in India and beyond. So really interesting developments at the consumer level. So that's the first thing. The second thing, and I'm talking to a conference, a global town hall organized by a media organization, which has seen through this sort of means the importance and change of digital in a market like India, which is still heavily dependent and centered around traditional media. Digital acceleration will have, or digital development and transformation and disruption will have an increasing impact on traditional media. We see it around the world with the impact on free-to-air media, on network TV, as the streamers, as Netflix, as Disney Plus. You saw what happened with Hamilton. When content is great and it's put online, the pull to the audiences is huge, even during lockdowns, or maybe stimulated by lockdowns. And we're seeing free-to-air television come under very heavy pressure. We're seeing newspapers and magazines fall. Rupert Murdoch, I think, has closed something like 100 local titles in Australia. We've seen the fall here in the UK of a number of print versions, which will probably, of newspapers and magazines, which will probably not come back. Again, I had dinner earlier this week with the international head of one of the major magazine groups, and he said basically advertising revenues had collapsed for the physical version. So this is going to have enormous impact, but it's an acceleration of a trend that was already there, or trends that were already there that are being driven faster. So media is being impacted, consumers, media, and then finally, and probably most importantly, the impact on enterprises. Managers of companies who before COVID-19 were jogging along, from 2008 after the great financial crisis, GDP growth was 2, 3, or 4%. So you could grow at 2, 3, or 4% your top line. You could cut your costs a little bit. You could buy back your stock, uncontrolled listed company, you could buy back your stock, and the EPS would rise by something like 5 to 10% a year, and it was fine. And on average, a CEO would last in an uncontrolled listed company for about 5 years. So it continued well, and it was a good legacy to leave. All bets are off now. The status quo has been disrupted. That Q2 is going to be a bloodbath. So there is no penalty now for coming out with bad results, or results that have heavy provisioning for digital transformation. So you are going to see, in my view, a swathe of provisioning by big listed companies. We've seen it in the energy sector with BP and Shell, I think, provisioning something like 23 billion US against the company, not purely for digital transformation, obviously, but for the energy and the oil price, but also for restructuring of their companies. They're using the opportunity, somewhat sadly, to make the restructuring changes that are necessary. I mean, it's a sad thing about human nature that in good times, you don't implement change because you're comfortable. It's only in bad times, when there's a burning platform, and COVID-19 is a burning platform, that you do it. So the third big factor is going to be, an influence is going to be on enterprise. So impact on consumers, impact on media, impact on enterprise. And the final thing I just want to say a little bit about is the changes that we've seen at S4 and that we see elsewhere. I mentioned the impact on travel. I mentioned the fact that, actually our operating profitability in May was up quite sharply in comparison to last year, because our indirect costs had fallen quite substantially. we've not laid off people. The holding companies are throwing out 50,000 people on a global basis, the ad holding companies. And in America, the ad holding companies and the independents are knocking out about 50,000 people. It's very sad and will have a dramatic impact on our industry. We've actually been hiring through COVID. Our top line for the first 5 months of this year is up 12% on a like-for-like basis and 14% on a pro forma basis. So we've actually grown through COVID by less than we wanted to, but we've grown through COVID. But what we're doing is raising our headcount from 2,400 to 2,600. So we've made the adjustments necessary to our travel costs and our non-essential business costs. We've reduced freelance, but we've maintained the fabric of our company, because as we raised last night 115 million pounds of equity, we're trying to prepare ourselves for the post-COVID world, for this next normal, and to be aggressive in terms of our expansion at a time when everybody else is pulling in their horns. So we will see, I think, a permanent effect on travel. I've heard several CEOs of companies much, much bigger than us. We're peanuts in comparison to them. And they're saying their travel budgets have gone to zero. It is highly unlikely it will go to more than 50% of where it was before. We're going to see an impact on office working. I mean, certainly in our own company, we're in 30 countries. We have 43 leases, we operate in 43 cities with more than 43 leases. We have multiple leases in many cities because we brought our company together very rapidly in the last 2 years. And what we've committed to is 1 property per city, and we're changing the footprint. Most of our people, they tend to be youngsters. 2,000 of our people, the monks as we call them, and on the content side, average age 32, 600 mighty hivers, the programmatic and data analytics people, average age tend to be around 25. And they've obviously, many of them don't have the resources at home. They might be living with their parents. They might be living on their own. They might be young couples with kids and not have the resources. So you have to be flexible. Some of them want to spend the full day back in the office, but most of them want flexibility. They want flexibility, 2, 3, 4 days working a week in the office, flexible commuting times, which can be very important because public transport is not favored at the moment with C19, and people want the flexibility of timing and transport. And obviously public transport is crammed in the morning and crammed in the evening and congested. So that probably will change, and that's going to have an impact on the demand for property. I'm not saying overall demand necessarily would be reduced that much, because obviously if you have physical distancing, which I think is a better description than social distancing because it's unsocial, but physical distancing will maybe increase the demand in some cases for space, but the pattern of demand is going to shift. A city like New York and Chicago becomes less attractive. A city like Boston, or indeed some of the West Coast cities, or Austin or Denver, become more attractive. Distance working is going to become more effective. So property demand is going to be, and then as I said, working from home, more flexibility is going to become more important. And I'll finish in a point with a point that Dean Fuller, Joe Fuller at Harvard Business School, it was an interesting presentation about the future of work. And he had his last slide in the presentation was about companies are going to become more about individuals than they are firms. So just in the way I described our personalization at scale, about the fact that we at S4, at Media Monks and Mighty Hive are creating content at scale and delivering it, distributing it algorithmically at scale, personalization at scale, the ultimate one-to-one communication that David Ogilvy in the very early days remarked, I know, with his history at Gallup and founding the agency, Ogilvy Agency, at the age of 40, the thing he fastened on. So nothing's new in a sense in our world. That personalization is going to become more and more important at the firm level. And you're going to have to think about your firm as a collection of individuals more than as a firm. I mean, a lot of old farts like myself, 75, think about how important it is for people to congregate, and it is. The water cooler conversation, the ideas that are sparked by dialogue. But this technology that we're using, don't forget that we always, as Bill Gates has often said, we always underestimate the pace of change. This technology, and you see it again, I come back again, it's the third time I've mentioned Mukesh Ambani and Jio and Reliance. Just look at that development. Look at that AGM yesterday. I'm very proud of the fact that we're involved with the MBIBE initiative, the education, the online education initiative around Reliance and the foundation and everything. And that's that has such tremendous social impact. But look at that and look at the pace and growth of it and just think about the implications of it. So this technology is not static. It will be. I'm not saying it'll be beam me down, Scotty, but we'll get close to it. And the need to travel, I mean, my travel pattern is going to change. I'm not going to do as many trips. I probably will do fewer trips, but for longer periods of time. I will move. You know, you can run a company or try to run a company in any part of the world. What we've gone through in the last 4 months proves it. So that's my summation of this next normal. Thank you very much.
So thank you so much for sharing your insights. We encourage everyone in the audience to keep visiting the Resource Centre for assets you'll find a lot of value in. Likewise, please feel free to visit our help centre in the lobby for any queries related to this event. And do keep an eye on the leaderboard section to discover and determine your overall score.